Hello, everyone. This is Alex,
I'm Joel.
and we are wealth advisors with a wealth management firm based out of Toronto, Canada. We serve multi-million dollar corporations as well as investors with 6 and 7 figure investment portfolios, Canada-wide, coast to coast.
And this is the Commandments of Wealth podcast, where we're going to be sharing some insight and strategies that we've implemented with our clients and business owners, as well as some of the insights they've shared with us on the road to build their wealth, preserve their wealth, and live off their wealth, as well as pass on their wealth to the next generation. So with that said, we have a topic that is impacting wealth, inflation.
Yes, absolutely. Inflation. I'm sure it's on everybody's mind, whether you follow the markets or you don't follow the markets, because I guarantee you when you saw those gas pumps, you realized that something ain't right. What was that joke? Hold up, wait a minute, something ain't right. Right? But so that's what we're going to be talking about today. We have a Forbes article here, which is talking about how inflation affects your retirement plans. So Joel and I, when we were going through this, we thought that this was a great, well-written article. When we were going through it, though, we noticed that they broke it up into different sections, but really, different sections are just asking the same question in multiple different ways. And the main underlying question that they're asking, which we wanted to expand on today, was how does inflation affect the way that you plan for retirement, right? So, let's start from the basics. The article does address this. We're going to first talk about what inflation is, how it affects us, and then quickly what's it been historically, right? Just for context, right? So I'll start by saying that inflation, for those of you that don't know, is when you basically supply and demand, right? So as they print more Canadian dollars, the value of the Canadian dollars that already exist goes down, which means that our purchasing power goes down. So if our purchasing power goes down, well, what does that mean? Well, it means that we're basically spending more money on our needs because our housing, our transportation, our fuel, our food, all of these things go up in price, right? So which means that you have less money to spend on your wants because you're spending more money on your needs, right? And then of course your wants still do also go up, right? So if you do still decide to spend on your wants, they're still going to cost you more, right? So now that we've just covered off what causes inflation and how it affects us, let's start by saying, okay, so right now, if you haven't heard, inflation from Stats Can has basically said that it's a 40-year high now at this point, 8.1%.
Yeah.
So, Joel, historically, what has inflation been in Canada?
So historically, I believe inflation in Canada has averaged around 2.5, 3% a year. But if you look at the last 20 years, inflation has been under 2. So historically, 2.5 to 3. The last 20 years, so since 2000 to about 2020, that was about 2%, a little bit under. And now we're sitting at about 8.1% inflation in Canada. And it was also pretty high last year.
Yeah.
So with that said, I guess the question becomes, do we think, there's usually two camps that people fall into.
Yeah.
We were talking about this before. Do we have an environment where inflation gets not a little bit out of control? We're talking about double digits, above 20% for a prolonged period of time. These are places like Lebanon, Zimbabwe, Venezuela, even places like Egypt are starting to have a lot of stress. Or the other camp is you get a spike of inflation, and then you have central banks raising interest rates aggressively, taking money out of the system to try to moderate inflation back to a target that's more sustainable for the economy and the people who live in those countries.
Yeah, exactly.
So I guess let's talk about the first instance, what someone would do, and then we can go to the second instance, the latter, and we'll go from there.
Right. No, sounds great. So as Joel was alluding to, we want to define our terms, right? That's always important when you're talking about things like finance, because you want to make sure that we're talking about the same thing. So when it comes to inflation, there's, like you said, there's going to be two camps, right? What if it's able to be reined in within an acceptable, time frame, and what if it can't be reined in, like some of those extreme outliers that you mentioned, like Zimbabwe, Lebanon, and Egypt, things like that. So let's start with the more extreme case, right? So let's talk about where the governments of countries that haven't been able to rein inflation in, even by doing things like raising interest rates. So we're talking again like Zimbabwe and things like that. What typically happens in countries that do that? Like if you put yourself in the position of just a regular average person working, making a living, when your currency gets devalued, the purchasing power, I should say, gets devalued that drastically, what ends up happening is you get your money and then you're saying like, it's a hot potato, I can't hold this.
Yeah.
I have to immediately put it into something, anything but what it actually is, in order to preserve that value. So that could be them buying gold, it could be them buying, investing in their stock market, it could be them buying more real estate, because all of those things that we just mentioned are more likely going to either keep up with or outpace inflation, or just not sink as fast as the actual currency itself.
There's a better chance of maintaining its buying power to buy than our necessities.
Yes.
Right? Real estate, food, transportation, things we need.
Mm-hmm.
So yeah, typically in that case, if it's high inflation, people, like you said, hot potato, they're trying to do those things, or as soon as they get paid, they are trying to convert it into currencies that hold their value, US dollars, euros, British pounds, if you can get your hand on it.
Yes.
Because some countries actually institute capital controls. It becomes very difficult to get those currencies. Why? They're trying to support their local economy and their local currency. So in those type of environments, that's what you're looking at doing. It's a hot potato. You do not want to keep your currency if it's being devalued by high inflation, double digits, 20% plus. You're actually looking at maintaining your buying power. You're looking at real estate. You're looking at gold. You're looking at converting your currencies into better currencies that will maintain their value, US dollar, euro. And that would be the game plan in that type of environment. And you kind of want to take steps to not predict it, but prepare for it.
Yeah, exactly. Right? Because I think that though we started with the more extreme case first, you have to pass the more mild case before you can get to the extreme case, right?
Hopefully.
Hopefully. Exactly, right? So that was great. So let's now look more domestically. And right now, the sentiment that we're receiving from the Bank of Canada and the government is that they believe that they can bring inflation under control.
That's the transitory word,
yeah,
right?
Yeah, the transitory, right? Oh boy, yeah, transitory. Yeah, if inflation's so transitory, show me businesses that reduce their prices.
It's hard to find one.
Right, it's sad, it's tough to find, right? Because I mean, like, I won't go off topic there, but so basically, if we're looking at the domestic, our government and the Bank of Canada, they're very confident, at least with their messaging, that they can bring this inflation in line by raising interest rates, among other things, within a respectable period of time, and they're calling it aiming for a soft landing.
Yeah.
Because again, like with gravity, what goes up must come down. But I mean, if you're at a 40-year high, it's going to take some expert level maneuvering to make that landing soft, because we're aiming for, again, 2.5%, 3%, right? And I know something that you and I were talking about a bit before was, do we even think that they're going to even get it back to as low as 2.5%? And realistically, I know that, it would be nice if we did, but we've had it that low for a very long time. So I wouldn't be surprised if they get it to 3-4% and they decide, okay, we're just going to keep it there.
There's other things at play that are pretty complex that we can get into it. But yeah, if you think we're in an environment of 3 or 4% for a longer period of time, you want to look at buying assets that can deal with inflation a little better. And again, if you're moving all your income needs, like your spending patterns to your needs, which is real estate, which is transportation, predominantly oil or sometimes EVs as well today, or food, then maybe you want to look at owning those type of assets, or starting to include a little bit more of those type of assets in your portfolio. Because if people are going to be spending more money on those type of things, those are the industries that are going to basically pass on the higher cost of their goods to the end consumer.
So that being said, what are some of the things that people that, like in our country, right, that where we are confident that this will blow over sooner than later and get back to normal? How would they, react to be optimal?
Well, it's it's very elusive to try to go into cash and hold on. And without talking about timing the market too much, we believe that it's better to own assets that can shelter you from that inflation, that can pass it on to society, and that you will benefit as a shareholder. Right? So it's about increasing diversification, owning productive assets that are part of society so you can deal with inflation, maintaining your buying power. Because if you have 3% inflation a year, and that lasts for 10 years, and you decide to go into cash and you're just hoping, your money will be worth 10 years times 3%, 30% left theoretically than 10 years ago when you had all that cash.
Yeah.
So if you're able to put it into productive assets that deal better with inflation, money today, being paid income today is worth more than money tomorrow. You want to look at some of those industries and increase some of your diversification if you don't have it.
Absolutely, that was very well put. Because again, the purpose of this question was really how does it affect retirement planning? So now that we've given you those scenarios, how this affects is because, again, when you retire, for the most part, people are working off of a fixed budget. Maybe not necessarily a fixed income, but a fixed budget.
Yeah.
So if your budget, is, let's say, $80,000 a year post-retirement, right? That's based on the assumption that everything more or less stays within the scope of what it is today. So now when you have 8.1% inflation, you're basically now saying that you're basically everything costs basically 10% more.
Yeah.
Right? And that's going to have serious ramifications, because now if you've said like, hey, I can live till age 90, 95 if I live off of this budget, then I have to spend more money just today, let alone if it continues to stack year over year, it's going to pose serious problems. But just finishing off, I'll say that the commandment of wealth for today is basically you want to make sure that you can preserve your purchasing power.
Absolutely.
You want to preserve your purchasing power. Whether we talked about assets, using assets, different types of assets, whether they're stocks, bonds, mutual funds, ETFs, real estate, insurance, even gold. There's many different things that you can use. They all have a purpose, and you want to make sure that based on your outlook, you're aligned with that. So that way, when you have issues like this, where we have these inflation rates. What they are, you can make sure that if you ever need to afford your cost of or afford your living standard, you can still do that.
You have to maintain your buying power.
Yeah.
It's a commandment of wealth. Maintain your buying power.
Yeah, exactly. So with that being said, everyone, that was today's episode. We'll have the link for the article in the description, so you can read that if you want to. Please comment, leave your comments down below.
Hit the like button.
Yeah, hit the like button. Subscribe.
Yeah, subscribe.
Right, subscribe. And if you want to actually talk with us to find out how we can apply what we've talked about today to your situation, we'd be more than happy to. Feel free to reach out to us, and we would love to have a chat with you. Have yourself a wonderful day, everyone.
Till next time.
Till next time.